How's it going, guys? And welcome back to the Blockware Intelligence YouTube channel. My name is Blake Davis, and we are back for episode 7 of Crypto Equity Investing 101. I've upgraded the sound quality here this week, so I hope you all enjoy that. But this episode is going to be about building a trading system, which is a little different than what we've talked about here in the past. It's a little bit more about the fundamentals of becoming an investor or becoming a trader, more so than the individual nuances of reading a chart and those kinds of things. But I think it's really important for a beginning investor to understand. So before we begin, I just want to remind everyone that none of the information in this series is investment advice. I'm not a certified financial advisor, and nobody should pursue any investment strategy without conducting proper due diligence. So let's get into it. What is a trading system? A trading system is basically just a set of rules or laws, if you will, that you impose on yourself. And why do we build a system? Well, it essentially works to help us combat emotional decision making, right? So if you have a set of rules that govern how you trade, a set of ideas that help you signal when you should be in or out of the market, it removes this X factor of making decisions on a whim. It helps us to understand exactly what we need to be doing at the right times, or when is the wrong time to be in the market. So it kind of just guides us in our path towards becoming profitable investors. So I've included a quote from one of my favorite books, Reminiscences of a Stock Operator, which I highly recommend everyone reads. I think it's for free on Spotify, the audiobook. But it reads, "I was 20 when I made my first 10,000 and I lost that. But I knew how and why, because I traded out of season all the time. Because when I couldn't play according to my system, which was based on study and experience, I went in and gambled. I hoped to win instead of knowing I ought to win on form." And this is kind of that idea that trading with a system gives us this set of laws that are based on study and experience that we know are going to help us succeed in the markets. So when we ignore our rules and ignore our system, we go in and we're essentially gambling and hoping to win. It tends to not work out. It can work on occasion, right? Anyone can get lucky and crazy things will happen in the markets. But over the long term, over many years and many market cycles, operating using a system is going to be the best way to do it. So now that we know what a system is and why it's important, now we got to talk about the key question, which is how do we actually build a system? So we need to find a rule-based system, and there's a million out there, and these come from books mostly. So these are investors who are writing about their system and what they found to work over their experience in the markets. And these books kind of provide us with this general framework. So you essentially read the book, find something that speaks to you, and then you start there, and you start just, I would say, investing with that strategy, word for word. And then over the course of years and lots of experience, you start to figure out what works for you and what doesn't. Maybe your risk preference is a little smaller, a little bigger. Maybe your time frame is a little different than the author's. But over time, you start to realize what's working for you, what you don't like, and then you kind of adjust that framework or that system to what works for you. So I've included some of my personal recommendations and my favorites. This is just what I found has worked for me in my experience, and it's not a one size fits all. But I think this is a good place to start. My number one book is How to Make Money in Stocks by William O'Neill. I've discussed this book a fair amount on this series, and a lot of what I've discussed here in the last 7 episodes has been built from that framework, from the Bill O'Neill framework. So his kind of general guide is called CAN-SLIM. That's the system that O'Neill style traders use, and that's an acronym. So it's CANSLIM, CAN-SLIM. It's currently accelerating quarterly earnings and sales per share. A is annual earnings increases. N is new companies, new products, new management, and new highs off of proper sound basing patterns. S would be supply and demand, so sort of that technical analysis aspect. L would be leader or laggard. So essentially looking at relative strength, as we discussed here last week. I would be institutional sponsorship, as we've discussed, right? Institutions are really important to keep an eye on, as those are the ones who really propel stocks through, multi-month basis. And then M is market direction, which is, just judging the overall trend of the market, which I'm going to do a full video on in the future. So, how to make money in stocks is I think the Bible of growth investment and this style of investment that I've been discussing here. William O'Neill is a billionaire trader who earned his wealth the hard way, just studying the market for a very long amount of time. Really smart guy, and he created this system that is used by a lot of people around the world. And I've found that it's probably the best place to start. In my personal opinion, it's the best place to start for the newer trader or investor. Another book I highly recommend is Secrets for Profiting in Bull and Bear Markets by Stan Weinstein. This is another great book. It's talking a lot about sizing up the market trend, so using what's called stage analysis to understand what stage of the cycle is the market in. And once again, I'm going to do a video on that trend analysis in the future. A third book, which is a little bit different from those first two, is called How I Made $2 Million in the Stock Market by Nicholas Darvis. So he was a trader in the 20th century who, he was actually a professional dancer. So I think this is a good book for those who aren't full-time traders, right? You have a job and other things going on. You can't necessarily watch every tick of the market all day. Nicholas Darvis was someone who was traveling the world as a professional dancer and would receive stock quotes in newspapers that he got shipped to him, and they would come, it would take a week to get out to him. So he wasn't watching the market tick for tick. He was actually watching it like a week late, and he still managed to become, an extremely legendary investor. And this book talks a lot about what's called the Darvis box. So it's essentially support and resistance. So I think it regardless of your personal situation, it's really good knowledge to have. Another one is Trade Like a Stock Market Wizard by Mark Minervini. I really like his style of trading, and he's been extremely successful, and he bases a lot of his stuff off the William O'Neill style. So that's why I think starting with how to make money in stocks is good, and then maybe following up in the future reading Mark Minervini's work, which talks a little bit more in depth, and it talks about a lot of his style is that VCP that I discussed last week. And then finally, I've included Technical Analysis Using Multiple Time Frames by Brian Shannon. And this is probably the most advanced technical analysis book of these 5 that I've included. But Brian Shannon, I spoke with him before. He's a really great guy, and he's got a really interesting system for investment. So he uses a lot of VWAP, which I'm going to discuss in a future video. So don't worry about that quite yet. And just using multiple time frames to find entry points for stocks, right? So maybe you start with the weekly chart and you find a multi-week setup, and then from there you go to the daily chart and you wait for a setup on the daily chart, and then when that day comes, then you're going to an hourly chart or a 15-minute chart or whatever, and then finding an intraday setup. So it's just using multiple time frames and some more technical analysis tools to guide your decision making. But those are, kind of my personal top 5, I would say, good places to start if you're looking to build a system. So now I'm going to get into some example rules, an example system. Obviously, this is only 8 rules here, but, and you'll likely have many more. I just wanted to provide, some examples of, what a trading system might look like. I think these are a really good place to start. And, once again, this is all my personal preferences. I'm not trying to say that this is the only way to do it. I'm just saying, based off my experiences, I think this is a good place to start, for a rule-based system. So the first one would be to only start positions within 3% of a pivot point out of a 7+ week base. So if you missed last week, I highly recommend going back and watching that video, and we talk about pivot points in bases. But this is just kind of that idea that you're looking to get that pivot point, and you're not looking to buy extended from a pivot point, because the more extended you are from the pivot point, the higher likelihood that your buy price will be retested in the future, or you'll be shaken out of your position, or that you're just buying too late and the stock's going to go and retest, and you could be shaken out. So in that, and it doesn't necessarily have to be 3%. That 3 to 5% of a pivot point is sort of the range that we're looking for. Secondly, which I think is really important, would be to journal before you trade. So what I mean by that is, if you've been scanning the markets and you find a stock setup that you really like and you're going to buy it, instead of just diving in first, almost blindly, I think it's important to journal out your trade beforehand. So say, what's the pivot point? Where am I going to buy this stock? Am I going to pyramid in? So am I going to buy using, a few different orders, or am I going to buy all at once, which I don't necessarily think is a good idea, personally. But journaling out, where your buy point is going to be, where your stop loss is going to be for those buys, and then I think the most important part would be to write down, why are you buying this stock? What on the chart or fundamentally stands out to you, so that if this trade ends up working for you, you can go back, in the future and say, oh, look at, this trade was a winner. Oh, here's what I liked about it, and learn from it. Or if it's a loser, you can say, okay, this is what I was looking at the time, and it ended up not working. What was the missing piece, or something like that. And then also, looking at your target, profit taking. If you're going to take profits at 20%, write that down. Set it in stone. Another example rule, as I just alluded to, is to never buy or sell all of your shares at once. So, if you're diving into a stock with your full position on your first buy, that first buy is generally, the highest likelihood of you, being wrong. So, if you're piling in all at once and the chances of you being wrong are higher, the chances of you, losing even more money are higher as well. But also, not selling all at once. So, a lot of times a stock can flash a sell signal, but that isn't necessarily, that means that today is the end of its run. It could just be signaling that, it's starting to get tired, and it's going to rebase in the future. So by not selling all at once, you allow yourself to be wrong, but still continue to profit. Another rule that I think is pretty helpful would be to sell half your position into earnings if you have less than a 15% cushion. So the cushion is just how far are you up in this stock, right? What's your profit? So if you're up less than 15% in this position, you don't have, too high of a cushion. So you don't have as much, wiggle room for you before, maybe you get stopped out or you give up, all your gains or whatnot. So by selling half of it into earnings, right? And earnings are these, really volatile moments in the market. That's when you see stocks, gap up or gap down, double-digit percentages in the morning. So I think by selling half of your position into earnings, you are protecting yourself from downside. So, if you don't have a lot of cushion and you're just, diamond handsing your position into earnings, right? It comes down to gambling a lot of times. So you just, you want to be right and you want to take that shot in the dark. But, for success over the long term, we want to smooth out our P&L curve. So by selling half of our position into earnings, we're taking some risk off the table. And if that stock does gap up, you can always add that 50% back. So now some more, moving average based sell rules. One could be that you want to sell half your position if it closes the day below the 21 EMA, which is one of my favorite moving averages to use. It's a good, short to medium term, trend indicator. So if the stock's breaking down below that 21 EMA, it's, potentially a fairly strong early sell signal. So maybe you want to sell half when that happens. And then you want to use the 50-day moving average, which I've discussed as like the guardrail, which I think is probably the most important moving average. So maybe if you sold half when it broke the 21 EMA, then you would sell that final half when it closes below the 50 moving average, 50-day moving average. Another way you could go about using moving averages, these are just examples. If you wanted to use that, 50-day, and maybe you're a little bit more long-term, you would wait to sell half your position if it closes the day below the 50 and then you would sell the final half when it's 5% below the 50-day. Or another way you could do it would be sell half your position if it closes the day below the 50-day, and then sell the other half if it closes the week below the 50-day, or something like that. Another example rule is just pulling from my risk management video is to have stop loss rules. So tell yourself, I will never sit with a loss below 7%. Always have a 7% stop loss on your initial buy. Or you can use some of those other stop loss rules, like picking a technical level and sticking to it, or using that 3-5-7 selling that I talked about before. And then finally, I think, obviously it kind of depends on your style, but for someone like myself, someone who's maybe swing trading or something like that, it can be really hard to keep track of having 15 positions at once. So you don't want to spread yourself too thin and have your attention going in so many places that you start to miss things. So I think having no more than, call it 5 to 8 positions is kind of that sweet spot. I feel like, just based off my experience and some of the studying I've done of other traders and talking to other traders, I think that that's kind of the sweet spot of not spreading yourself too thin, but allowing yourself to have a few things going at once. And then I want to talk a little bit about overtrading here as well. I think overtrading is probably the number one issue that traders run into. I would say probably every trader runs into this issue at one point or another. And this is just that idea that, maybe you're watching the market too closely and you're taking, you're hopping on too many buy signals and you're overbuying, or, you start to see some signs of weakness and it makes you dump your position, or, just kind of those things. And you're over trading, right? You're making it too complicated. And that can really hurt your P&L and it can hurt your profits a lot. So this overtrading kind of stems from a lot of things. I think some of the main ones would be, FOMO, fear of missing out. You want to squeeze out as much gain as you can. So you're hopping into stocks, kind of on a whim. You're overtrading, which can cause some issues. I think watching the market too closely can also definitely cause overtrading. So if you're sitting there and you're watching the 5-minute candles all day from open to close, you're going to see buy signals and sell signals all day long. But the time frame that you're on is kind of determines how important the signal is. So a buy signal on the 5-minute chart is not as important as the buy signal maybe on a multi-month breakout kind of thing. And then also overtrading, overall just kind of just stems from emotional decision making. So by listening to your emotions and maybe ignoring your rules, you're going to overtrade. So having a rule-based system that tells you exactly when we want to be in and exactly when we want to be out can really help us stop from overtrading. So some of those ways to fight it, other than obviously having a rule-based system, would be to only buy out of sound basing patterns. And these are some of the things that help me. And obviously I'm not perfect, and I think people struggle with overtrading for a really, really long time until you're really advanced and sound in your experience in the markets. But only buying out of sound basing patterns helps you to kind of ignore those other buy signals that you might see. If you look at an hourly chart or a daily chart, you're probably gonna be able to find a buy signal extremely often. Almost every single day you'll convince yourself there's one reason or another to buy a stock. So waiting to buy out of those 7-8 week bases can help you to stop from overtrading. And then also using weekly charts. So like I discussed, longer time frame charts are more significant and longer term breakouts are more significant. So if you use a weekly chart, it kind of filters out all that wiggle from the daily chart or even an intraday chart. So by using a weekly chart, it helps us to identify these sound basing patterns that our rule-based system has helped us to identify. And then finally, I just want to talk a little bit about having a trading routine or an investing routine, which is super important. So it helps us to keep up with the market essentially. So by having this set routine, you don't necessarily have to write it down in your schedule or whatever. Just knowing mentally that every day or every week you need to do X amount of things in order to keep up with the market can be super helpful. So, and trading doesn't have to be a full-time job, right? Not everyone can afford to, or have the experience to, trade full-time. And, you have a job, or, maybe you have a job, elsewhere during the day, and you can't watch the market all day. So you can still create a routine to keep up with the market, even though you're busy doing other things. So I'd say intra-week, on weekdays, maybe just go through charts at night and flip through, make a watch list and flip through it at night just to kind of keep up with and understand what's going on in the markets during the week. So, even if it'll take you 20 minutes, right, before you go to bed, just flip through charts or something like that. And you're now flipping through charts and you're looking at, your watch list, and you can build a watch list over time and go on Twitter and just, type in all the tickers that you see people talking about. And over time you build a watch list that's, 2, 3, 4, 500 names long. And then that can help you, really understand what's going on in the markets. And then you flip through that watch list and you find, stocks that stand out to you. And then put those on a separate watch list to, keep an eye on later in the week. And you can, maybe find, setups, or if you're just starting out, you find stocks that you think look good, and then you can go back a couple days later and figure out, if you were right, if you were wrong, why you were right or why you were wrong, those kinds of things. And then, if you're working elsewhere during the week, you can't watch the market 24/7 or, when it's open, you want to set alerts. So you can set up your charting software to, send you a ping on your phone or an email or whatever, or a text, when, this stock is crossing above, this price point. So you go through and you find, quality looking setups, and you say, this is the pivot point here at whatever, $20. And then you set an alert there, and then, tomorrow when you're, working and you get an alert that, that stock's crossing $20, then you can maybe go on there and buy it or whatever. That's kind of in the middle of the week. But on the weekend is where most of the work is done for most investors and traders. I just said 75% of the work. I don't know. That's just a guess. But, the weekend is where the vast majority of the work is being done because the market's closed. So you can catch up, right? It can be really hard to keep up with everything that's going on in the market during the week. Everything's moving at once, and there's so much going on. But over the weekend, the market's closed. So it allows you to catch up. And you can just spend, an hour or two on Sunday, just go through charts, right? I go through hundreds of charts on the weekends, every weekend. And what it does is it helps me keep up with the market and catch up to the market. So what I like to do is, I go through all my charts. I use scans. So those are, essentially and there's free scanners online you can use too. But you're essentially typing in set criteria. And that provides you with a list of stocks that match those criteria. And there's pre-made scans as well. You don't have to customize them yourself if you're not quite there yet. But, scanning the market, looking for, certain things in certain stocks, and just using your, master watch list, if you will. So your, 500 plus name watch list or whatever, and going through that as well. And just, jot down in a notebook, what names stand out to you. So maybe you go through 1,000 charts and you find, 20 names that really, really stand out to you. So now you write those down and you write, why do they stand out to you? What on the chart or what fundamentally, makes you excited about the stock or makes you feel like, it's gearing up for a breakout. And then writing down, buy points, where's the pivot point on this base? Where would I like to be buying it? Setting alerts, those kinds of things. And then also the weekend is a really good time because you probably have some little more free time than during the week to read some books, read some of those investment system books and take in more rules and analyze your trading, listen to podcasts, watch YouTube videos, those kinds of things, and just expand your knowledge base because during the weekend you're busy and the market's moving and you have whatever going on at home. It can be really hard to, spend some time to, expand your knowledge. But over the weekend is a great time to do that. So that is all I have for you guys here today. I appreciate you all who stuck around to the end. And, if you're enjoying this content, feel free to leave a like and subscribe to our channel. Maybe comment below some feedback or things you'd like to see in the future. But that is all. Thank you guys.